Under assignments, the first one will be this right here. So chapter 1 and 2 handout. So we're going to finish this today, hopefully. The due date is always a week from the Friday. Let me see if I said that correct. So Friday, the 29th, so the 5th is a week from Friday. So I always give like to Friday plus a week to turn those in. But this is where you would submit it, the handout. And the handout has both stuff from the chapter, from problems in the chapter that I put in it, and it's also got other things too that are usually from the CPA exam. All right, let's see. All right, so I email you the problems and also get it turned in, but they're also available here. So this is the same handout that you got on your email. These are the same ones. So if the email doesn't work or whatever, you can get the stuff in there. Okay, exams. Exams are only emailed. They are not in Blackboard. And an obvious question is why? The why is because people have different versions of the exam. Those are no. But they will be submitted in Blackboard. Same as the rest. So these are everything's submitted in Blackboard. Assignments are usually due 1 week after. And the grades are only included in the grade calculation after the due date. Okay, now here is the important one. Okay. Important, I messed up my spacing. Late work is accepted without penalty. Okay, so hello? Okay, well, late work is accepted without penalty. So what I mean by that is if let's say that you missed the deadline for whatever reason, then you don't need to tell me why. But whatever reason you missed the deadline, that's fine. You can turn it in. Now, it's not going to be in your grades until you turn it in. I got a new camera, that's why I'm looking in the wrong spot. But it's not going to be in your grades until you turn it in. So it'll be absolutely accepted, but until you turn it in, your grade's going to look bad. When you turn it in, the grade will jump back up. But it can be turned in late. Everything is due by the end of the semester. So by the end of the semester, you should have everything in. But individual due dates are not hard due dates. And what I mean by that is you can still turn them in and get full credit, but your grade will obviously look bad until you do turn it in. Because after the due date, then I include it in the grade date. Okay. Grading scale, blah, blah, blah. Okay, so here's what's going to happen. So here's the what we're going to cover. The first one you might think is very odd looking, and it kind of is. And this is the audit sampling. There's actually 4 handouts for this. And those are done throughout the course. And the reason we do it throughout the course is it's nice to break it up. So oftentimes we'll have a chapter and then we'll have the sampling stuff. And again, the reason why we do that is so that it helps break up the class, but it also helps break up the sampling. Doing a bunch of sampling right in a row generally tends to it gets confusing. It's just easier to do it a few chunks at a time. So that's why we do it there. Okay. So the first chapter that we're going to be getting tested on is going to be chapter 1 and 2. What will happen is next week, we'll go through the chapter 1 and 2 handout. Okay. Next week, we'll go over a multiple choice questions, CPA questions for the chapter 1 and 2. And then I will send out the chapter 1 and 2 exam, and you'll have till Friday plus a week to turn it in. So the first exam will be due on, what's 5 plus 7, 12? So this will be due on Friday, 9/12. But I won't send that out till next week. Oops. So this is kind of what we're going to do the first, and once you get used to it, this is the way the rest of the chapters are going to go. So, usually we'll have a week or two on them, and then have the exam, a week or two out of them. The only one that's different than that is that we'll do these 4 handouts, and then we will have the chapter 9 exam, probably somewhere around, I don't know, week 11 or 12, somewhere in there. I think we have week 14 off. Yeah, okay. All right, any questions on it? Okay, I'm going to look like Bradford. Actually, I'm going to go to my other camera and start in on the chapter 1 and 2. Hey, almost makes you forget that I look like it. Oh, I gotta ask you guys something. Is this showing the right way on your screen, or is it mirrored?
It's all good.
It's good.
That's good.
Good. Distorted right now. All right. Uh, I'll play with it. Okay, so one of the things we're going to start out with is kind of starting out with the end. And the last thing you do on an audit is write the audit report, and that's what this is. So this is an audit report, and one of the reasons why we're starting out on it is because there's a lot of stuff in it that in the audit report you can actually learn about a lot about what auditors actually do. And basically, what you have is a teacher that looks like Dracula. I'm in my basement. That's where it looks way I keep down here. So what you have is companies are going to put out their financial statements. And the people reading the financial statements have to know whether they can trust those or not. Right? I mean, it makes, if there was no one checking on it, they could do anything they want. They could make up numbers, whatever. So what auditors do, what CPA firms do, is they go in and they check and they make sure that um, the numbers are reasonable that the company is reporting, basically, and that's it. And so we always try to, and we don't look at everything, but we look at it as stuff to make sure that those financial statements are, if they can be relied upon. You know, it may not be accurate right down to the penny, but it's not going to make a difference to whoever, a reasonable person if they are off a little bit. So that's kind of what auditing is. It's simply someone else looking at the financial statements who is objective, looking at those financial statements and putting and offering a report that goes with it. And the report will either be good or bad, basically, on whether you can trust these financial statements or not. So that's what a financial audit is, and that's what kind of the whole CPA exam and becoming a CPA and all that, that's what it's centered around. CPA is a license to do these audits. Not everyone can do them. Only CPAs can. You're licensed by the state to perform these audits. And they're basically there, again, just so that people reading the financial statements can trust them. And the financial statements will be issued by the company. The company makes the financial statements, they issue them, but this audit report will go along with it. And so when you look at a company's financial statements, the audit report will be included on there, and you can read the audit report and see whether you can rely on the financial statements or not. So that's what the whole idea is behind it, is that this report goes along with the financial statement, and it simply tells people whether you can believe it or not. All right. I got the Dracula light back on. All right, so go ahead and get my marking. Okay. So this is the standard audit report that you will issue with a company that is, hey, there's a spider on my, can you see that? There he is. That's a spider. The tiny little spider. Okay. So this is a standard report. And I'm going to go ahead and tell you one more thing about this report before I get into it. And that is that the wording on this report is very important. It's required. You must use this wording. You cannot use, you know how we always say don't plagiarize things, don't plagiarize. If you're a CPA, you are required to plagiarize. And you're required to plagiarize because this is standard wording. They don't want, they want people to be able to read it and know whether the financial statements are, you have to use this wording. You cannot deviate too far from it. You can add things to it, but you must use this wording. So this wording is actually very carefully crafted, and you're required to use it. Conversely, if you're not a CPA, you are prohibited from using it. So you cannot use you cannot use this report if you're not a CPA. It's copyrighted material, and you cannot use it if you're not a CPA. But CPAs are required to use it. So this report is a little bit different than maybe say a regular report you would think about. It's actually required wording. Okay. So let me see. Let's try this one. All right. So this is the I mentioned this already. It's issued to the to go along with the company's financial statements. And it's called the Independent Auditor's Report. So this is what a CPA is, Certified Public Accountant. And notice who they issue it to. Shareholders and the board of directors. They do not issue it to management. And there's good reason. Management made the financial statements. They should already know about the financial statements. So this is issued to people outside. So these are people who are outside of the company. Some board directors will be inside, but some of these will be outside directors too. So we're issuing this to outsiders. Okay. So the first paragraph, we tell them that we've audited the financial statements. We tell them which ones: balance sheet, income, change in stockholders' equity, and cash flow. So those are the four financial statements. Statement of income. So balance sheet, income statement, statement of equity. This is also going to be statement of retained earnings, and cash flows. Okay, now this is one of the newer forms. This is the newer report. They used to put the opinion at the end, but people would all just go to the end and see what the opinion is. So they start right out with, you can't see that. Now I just crossed out, okay, don't use that line. Don't use that item. Pink. We'll try a pink one instead. And the wording here is very, it's not precise. The financial statements present fairly in all material respects. Financial position, you don't need to know that, but this is actually the balance sheet. And the results of operations and cash flows. Results of operations is the income statement, cash flows. In accordance with accounting principles generally accepted in the United States of America. So we have to tell which there could be international standards also there, but usually the United States is going to be the accounting standards for the United States. Okay, so notice that the opinion says that they present fairly in all material respects. It doesn't say in all respects. It doesn't say that it's accurate down to the penny or anything like that, but they're not materially misstated. That's a very important distinction, because some people think that it's down to the penny. It's not. Okay. Basis for our opinion. Let's go back to something we can actually leave it. Okay. All right. So this has accounting standards. The basis for our opinion says that we have conducted our audits in accordance with auditing standards generally accepted in the United States of America. So let's make the distinction here. These are the accounting standards for their financial statements. So this is what ABC company, this is our, you can see it. This is our client, ABC company. They must follow these accounting standards that we set out here. Whatever the accounting standards they're using, we'll put in there. The basis for our opinion, those are the auditing standards. These are what the CPA firm must follow. So these are for the client. And this is for the CPA. So the auditing standards are by the CPA. So we tell them we're using the auditing standards in the United States of America. They could be international standards, but usually they're in the United States are going to be the United States. Question on that? So those first couple areas, this gives us our opinion. This tells what we audited. This is our opinion on those financial statements. We tell them what standards that they're using for the accounting. and we're telling them what standards we're using. Again, these could be international standards, but as they usually they're US standards. But if they were, you just say international standards. Okay. Now, we start getting into responsibilities. What are we responsible for? What is the client responsible for? So this is the client, responsibilities of management. This is our client. This is ABC. Our client. Manager responsible for preparation and fair presentation of financial statements in accordance with principles generally accepted in the United States. They don't match that up there. And they're also required to maintain internal control. So they're required to have an internal control system that allows them to prepare these financial statements. Fair presentation. Okay. Preparation of the financial statements, management is required to evaluate whether there are conditions, events, considering aggregate, raise substantial doubt about the company's ability to continue as a going concern. This is a big area nowadays. Actually been a big area for a while. And this is a little bit, in some ways, it's a little bit strange for an audit. And I'll tell you why in a second. Well, I'll tell you why right now. So going concern. A going concern is when a company is possibly going bankrupt. So we have to evaluate whether we think the company is going bankrupt. And here's why this is a little bit odd. It's a little bit odd because notice you're reporting on the financial statements. Okay, let's say a company is going bankrupt. You know, they can still put out their financial statements and they still can be fairly presented, right? I mean, they'll look bad, but you know, the financial statements will be fairly presented. This is a judgment call. And this is why this is a little bit strange in some ways, is that we're simply looking at the financial statements. However, we also are looking at whether this company will keep going as a going concern. In other words, it won't go bankrupt. And if it is going to go bankrupt, or if we think that it might go bankrupt in the next year or two, we will report on that. And here's why this came about. You said, well, why are we doing that? Isn't it up to people who look at aren't they looking at the financial statements? Can't they tell when the company is losing cash and all that kind of stuff? The problem is a company would be doing charitable. The CPA firm would put their report. It would say, hey, the financial statements are fairly presented, and the company would go bankrupt. And people say, well, how did the CPA firm give this company a stamp of approval, and then 6 months later the place went bankrupt? Well, the financial statements were fairly presented. Now, notice a company that's going bankrupt doesn't necessarily mean that their financial statements aren't fairly presented. So this is a little bit strange, but it's to kind of close that gap about what people expect. Sometimes you got to really tell people, oh, by the way, look at this, they're losing, this much cash, and they have no financing to replace it. That's in the notes, and pay attention to this because it looks like they could go bankrupt in the next year or two. So is to close that gap about what people expected from the audit, even though it's not really what we're there for. We're there just to see if the financial statements are fairly presented. We also have to make this judgment call, whether we think that they're going to be around for the next couple of years. All right. Now, the auditor's responsibility. So this is what we are responsible for. And this is the kind of the important one. This is what all our auditing standards are related to. We are to obtain reasonable assurance, but whether the financial statements are free from, as a whole, are free from material misstatements. Whether due to fraud or error, could be either one. And to issue a report and that in our opinion. Now, we're going to tell people this reasonable assurance. It's a high level, but it's not absolute. And that's very important. That we get reasonable assurance. We don't get absolute assurance, of whether these financial statements. You think about some company, think about Walmart or something like that. If you had to, if you're looking at their sales, absolute assurance would mean that you'd have to go through each of their transactions and look at all their stores they have and thousands of people going in and every one of those transactions, and they do that 365 days a year. It would be impossible. It would be absolutely impossible. And things like inventory for Walmart. They have all those stores and warehouses and trucks on the road and everything else. To audit 100% of their inventory would be, there's not enough auditors in the world to do that. So we get reasonable assurance. We take a sample, like we were talking about before, like the yes, sampling. We take a sample, and oftentimes you can get, with not that many, you can get a very high level, 99% level or whatever. So this is a very important statement, and this is just to let people know that we don't get absolute assurance, and we're only looking for things that are material. Okay. And we're looking for material misstatements. Now, an obvious question is, what's material? Is $5 million material? I mean, it is to me.
Would it depend on, I guess, the volume of the company or the revenue that the company actually have?
Yeah, exactly. If it's Walmart, I can tell you it absolutely is not. It's not material at all. 50 million is a material. It depends on the size of the company. A smaller company, yeah, 5 million might be huge. A large company like Walmart, even up to 50 million is likely not material. And here's the important thing about that. So are you looking for $50 million errors if you are auditing Walmart? No, you're wasting your time. You're looking for $50 million errors. Now, if you come across an error, obviously of 5 million or something like that, you're certainly going to tell them about it and let them know, there's a problem. But yeah, as far as the report is concerned, you get a clean audit. So if it's not material to the company, they are going to have, every audit I've ever done on, there's no problems. Usually they're not big, but those are things that you'll give to them and let them know that those are problem areas. Is probably a better way to say it, but they're not going to affect the audit opinion. So it really depends on how big the company is. And again, sometimes people will say, there's someone embezzling $10 million from Walmart for 5 years, and the auditors never caught it. Auditors weren't looking for it. And it probably would have cost more than $10 million to find it. There is also a practical level of it costing more to find the fraud than the fraud is itself. And that's not a very good thing to do. All right, let's go back to, no, don't. Sorry, that was me clicking. Okay. So let's go to the next page. Now, the next page talks a little bit about the problems we have. Let's see. By the way, if you want to do this in Word, you're perfectly welcome to do it. You don't have to do any of this. And by the way, the stuff we're doing right now, the highlighting, we're going to get, if you look to the next page after this, we're going to answer some questions. But if you want to go through the stuff in Word, that's fine. All right. This is an important statement. The risk of not detecting material misstatements resulting from fraud is higher than one resulting from errors. Okay, so fraud resulting from, a material misstatement resulting from fraud is much more difficult to find. And they go into tell why. You get people colluding, forgery, intentional misrepresentations, a variety of internal controls. Basically, if a company is doing financial statement fraud, they're going to be working against you, which is different than if you're just looking for, the unintentional error. They're going to be intentionally trying to mislead you, and that is much more difficult to find. And if you think about it, they have, an audit, you may come in for, audits are usually say 3 to 6 weeks, maybe a little bit more. You're there 3 to 6 weeks. They're there, all year round. They have a lot of time to make things look like they are on the up and up. Now, if you do suspect it, though, and you are required to look for it, that is a big part of your job, is to have that professional judgment of that they might not be on the up and up here. They might not, the stuff they're handing me may not be what it appears to be. And you're always on the look out for that. And that's kind of what it goes to in the second one. We talk about maintaining professional skepticism. So even though it might not appear that there's a problem, there could be. Okay, I'm going to skip it. This is kind of repetitive. Let's go to the third sentence here, and that is, we do look at internal controls. Make this orange. You are required to get an understanding of their internal controls. But not for the purpose of expressing an opinion on the internal controls. A regular audit, we don't have an opinion on the internal controls. We'll find out that some people are required to do that. Some clients are, but for the most part, a general financial audit, you're not required. Okay, and you can read through the rest of this. There's not too much. Okay. Now, this other information, the auditor has not identified an uncorrected material misstatement of the other information. This is kind of a new one. And I'll tell you what that means, what it's talking about. So other information. So usually these financial statements are given in annual reports. These annual reports will say, maybe I'll pull it. When we go on break, I'll find one and pull it up. But their annual reports are usually somewhere between say 80 and 150 pages long. And about right dead in the middle of it, you're going to find the 4 financial statements and the audit report. Sometimes the audit reports before, sometimes after, but regardless. So, they're going to have 100 pages basically, and right in the middle, there's going to be these 4 financial statements. And these financial statements are what you report on. That's what you do your audit report on, these financial statements. Now, there could be stuff in that annual report that doesn't match the financial statements. What do you do with that? Suppose their sales are $500 million. Okay, they have $500 million of sales. You're reading through their annual report, and they say that their sales are $600 million. Now, notice it's not in the financial statements. It's a mismatch. They're saying it's 600 million in the write-up, in the 40 pages before the financial statements. When you look at the audited financial statements, that are only 500. So the question is, well, what do you do with that? Well, that's what you're checking for. And if there is a mismatch, you put it right in the audit report. You say, by the way, they're lying. They say that their sales are 600 million. And that's where you would put it in that audit report. Now, the audit report could still be a clean audit report based on the financial statements, but you're letting the people reading it know, by the way, this other information that's attached, the first 40 pages or the last 40 pages or whatever, this is a problem because they are misstating it, and you put it right in the audit report. And the hope will be that will stop them from doing it. Basically, you can't put that in the report. We are putting it in the report unless you take it, correct it and say it's 500 million. And by the way, these audits are not, you don't surprise them with a bad audit or something like that, or putting something in the audit report. You generally want them to make the financial statements, and the other information that they have around it. You want them to do it correctly, and you give them every opportunity to do it correctly. Okay. Other legal requirements, this depends on what you're reporting on. For instance, government reporting. If they have a government contracts and things like that, you may have something in there. Key audit matters, CAMs. These are things that are significant to the audit and that you may put in the audit report. So these are not required. Not everyone will have them. Not everyone will put those in, but they are available. Okay. Signed by the audit firm. This is the CPA firm. And it must be the CPA firm, not an individual CPA if it's a firm. The city. This is kind of new in the last 5 years or so, where the auditor's report is issued and the date. And the date is basically the last day of field work, the last day the auditors worked on the audit. So the date of the audit report is the last day the auditors worked on the audit. And that's kind of important because things that happen after that date, they're not responsible for. So for instance, so if the date of this was February 3rd, anything that happened after February 3rd, the auditors would not be responsible for. So the last day of field work is the date it's signed is a little bit important. Okay, what time is it? Let's go to page 3. Finally, some things to do. All right. True or false? Okay, the audit report is addressed to the company's management.
False.
Well, maybe I should circle it instead. Yeah, I'll circle it. The audit report is addressed to the company shareholders.
True.
The financial statements are the auditor's responsibility.
False.
Yep. Management's. I left the T out. There we go. The audit report gives an opinion on the company's financial statements.
True.
The audit report gives an opinion on the company's accounting system.
False.
Both. Yep. And again, they may have, maybe not the best records and all that kind of stuff, but if their financial statements are not materially misstated, they get a clean audit report. Okay, the audit report references the accounting principles used to prepare the financial statements.
False.
Actually, it does. Early on, it's for the but it's not for the auditors. It's for the I'm sorry, on page. So we do get the accounting principles, but this is what as it applies to the client making the financial statement. So actually, they do have those, but they're not. These are for the management preparing it. The audit report references the accounting. Yes. The audit report references the auditing standards. Yep. Auditing standards of auditing standards is nice up in the United States. So we give the accounting standards here, whose rules for the financial statements are they following, and then what rules are the auditors following? True. The audit provides an assurance that the financial statements are correct.
True.
Actually, it's false.
What?
We never use the word correct. We use
okay.
reasonable and only materially misstated. So they might be misstated, but they shouldn't be materially misstated. The audit report provides absolute assurance.
False.
Reasonable. And so you kind of see that the audit is not is down to the very letter that you might think it is, and that people I think oftentimes do, and what's expected of it. Okay. Chapter 1. Go to this page and we'll take a break. Are we still recording? Good. I couldn't get this thing to keep recording. I was trying to finally, oddly, I had to turn off recording and then it started recording. All right, basic accounting steps. Okay, get a client. There's actually a few more steps in that. This is chapter 6, by the way. Gather evidence. Oddly, this is chapter 5. Issue an independent opinion on the client's financial statements. This is chapter 17. So you get a client, you go get all the evidence you need to determine whether they are you're reasonable assurance that they are free of material misstatement. And once you are comfortable with that, you're going to offer the opinion. Another thing, though, that's important is while it is an educated opinion, it's also an opinion. And opinions, by their nature, are not always, as 100%. So one of the reasons why we call it an opinion is that it's an opinion. It's an educated opinion. It's a, we have reasons why we believe it. However, it still is an opinion. It's not as it's not an opinion like, oh, in my opinion, the best color is blue. It's not like that. It's an educated opinion that you get your data, you have your reasons why you believe that the financial statements are free of material misstatement. But it is, in the end, an opinion. And one of the reasons why they do that is even going into court, if someone sues you, it's your opinion. And as long as you can back up your opinion, oftentimes, that's what you just need to do when you go to court. Now, if the stuff you collected does not back up your opinion, then there's a problem. But the opinion itself, your opinion is backed up by all this evidence you get. And you're going to keep that evidence after you do the audit, you're going to keep that evidence in case someone does sue. And oftentimes, if something goes bad with a company, the auditors do get sued, and they get sued because, for one thing, a lot of times they're the only ones left with money. If the company goes bankrupt or something like that, suing a company that's bankrupt doesn't get you anywhere. But the auditors are the only ones left that have any money, so a lot of times they would get sued. But as long as you can have that information to back up your opinion, usually that's enough. And again, because it is an opinion, it's not an absolute. Okay, demand for audits. This one's a little bit tricky. This is a CPA question, though. What do independent auditors provide to the financial statements?
B.
Yes, very good. Credibility, that people can rely on them. We don't say they're accurate. We don't give any additional information on the financial statements. And we sure don't give absolute assurance. We give reasonable assurance, but we do give credibility. So someone says, okay, somebody else has looked at this and they came up with a reasonable, opinion that these are free of material misstatement. So the only thing we give is credibility. Okay. Let's go to business risk and information risk. Business risk. Business risk risk is the risk that a client will go bankrupt. So it's the risk of being in business that you might lose money. Information risk. Okay, this is the risk that an undetected material misstatement what idiot made this handout? The undetected material misstatement will appear on the financial statements. Okay, so it's a risk that an undetected material misstatement will appear on the financial statements. Now, if you detect a material misstatement, you tell them to fix it, and they don't, that's a different thing. Then you're going to change your audit report. But an undetected one is you don't know there's a material misstatement, and it appears on the financial statements. Which one of those two are you most likely going to be concerned with if you're an auditor?
The information risk.
Yep. Yeah, information risk. The risk that this is going to happen. There's going to be a material misstatement that you don't know about. While you do have to do a check to see if you think that they're going to go bankrupt. That is kind of a secondary thing, and that actually comes out of, making sure the financial statements are fairly presented first, and then doing your analysis to see whether they're going bankrupt. But this information risk is the biggest one. Right? So, because that's the one that's going to be and usually, like, if you're sued, is usually something based on the information risk. Even if it's going bankrupt, it's gonna be something on the information risk that you didn't catch. Okay, let's go ahead and take a break. We'll take like a 10-minute break. Let's say be back at, what time was it? 6:50. I got 6:54. So we're at 6:55. So we'll say 7:05. All right, we'll take a 10-minute break. Come back. Let's see. I'm gonna try and see what's next here. Okay. Yeah. Okay. Okay, next page. Second here. Sorry about that. Corporate governance. When they talk about. So, turning off the mics. Your speaker is not working properly. Yes, it is. Okay, sorry about that. So when they talk about corporate governance, this is actually a big part of it. The kind of the tone at the top, people are at the top of the place. The board of directors, they have corporate governance, they have oversight. Of management. Some of them are inside directors, they work at the company. And some are outside. Okay. Now, if it is, excuse me, if it's a publicly traded company, if it's a publicly traded company, they are required to have an audit committee. And this audit committee can only have outside directors. They cannot be people working inside the company. Oops. And it'll be a subset, so if they have whatever, so they have, 14 directors, maybe the audit committee will have 5. It'll be some subset of that, and they have to be outside directors only, and they have to have at least one financial expert. Does not need to be a CPA, but they have to be a financial expert. And so these are the oversight people that are overseeing the company. Okay, types of audits. I changed this a little bit. I thought I'd taken that out. We'll come back to this. See page 13, and we will come back to this. I think it's page 13. Oops. Yeah. Okay. So let's go to the next page. And this is where we get into kind of the wacky stuff of the structure of accounting. Okay, non-issuers. These are privately held companies. And this non-issuers is the terminology that we use for them. It's kind of a funny name for them, but privately held companies are called non-issuers. issuers, on the other hand, hey, where's my other market? Here it is. Here it is. Issuers. These are public companies. You can buy the stock in there. Okay, so which type of a client is Microsoft? Are they a non-issuer or an issuer?
Yeah, sure.
Yeah, they issue stock. You can go buy, Microsoft stock. So Microsoft would be a sole proprietorship. Well, sole proprietor, yeah, there's only one person. And by the way, even though you're the sole proprietor, you may still have to get an audit, maybe for a bank loan or something like that. But oftentimes they don't have external audits unless it's required by some, so either investors or bank or something. Okay, American Institute of Certified Public Accountants. This is a CPA club. The AICPA. When you pass the CPA exam, they'll send you an invitation. Hey, we noticed you passed the CPA exam. Do you want to join our club? You do. It's $300 a year. But the AICPA is an organization. It's a professional organization, but they're just a club. They're not a government agency at all. They're like the Boy Scouts or Girl Scouts or whatever. They're just a club, and they have no direct power over anything. It sounds strange, but they really don't. Their power is all derived from government agencies, any power that they do have. So it's just a club. And like I say, you pass the CPA exam and they will say, do you want to join our club? Now, what do? They make the accounting standards. They make the auditing standards. And they also make the CPA exam. I'm definitely going to use this to improve my handout. Not going to help you guys, but the next class won't have to suffer through this improperly spaced handout. And look how much room I give to these two. These two are one-liners. All right. So they make the accounting standards, they make the auditing standards, and they also make the CPA exam. Now, the CPA exam that they make is, I can't find my mouse. There. Oh, you got a scholarship. Oh, great. Yeah. And you get scholarships from them. They also have some plans too that they'll pay for CPA, taking the CPA exam if you become a member. There's a lot of stuff that they do. There's the Illinois chapter of it, Illinois CPA Society, and they are also a good people to know, and it's good for networking too. Pretty good. Okay, so the CPA exam, I should probably talk about that because Okay, the AICPA, they make the CPA exam. And again, this is just a club. Hey, we're a club, we made this CPA exam. However, every single state uses their CPA exam to license the CPAs. They don't have to. You know, the state of Illinois could get up tomorrow and say, we're going to make our own CPA exam. I seriously doubt they would do that, but they could. But every single state uses the AICPA's CPA exam. So they make the CPA exam. They're the ones that determine what goes on it. And that's the exam that's used for license. So in that way, the CPA exam is very important because not because of the AICPA group, but because the states all require it. And the good thing about that too is that if you do pass the CPA exam in one state, you can generally take it to the other state, another state, without too much difficulty. They've really loosened that up. Back in my day, back 100 years ago, it was really difficult to go from one state to the next. They had all these different rules for passing the CPA exam, and they would say, oh, you didn't pass it under our rules because we require X, Y, and Z extra stuff. So, but nowadays it's very easy to go from one state to another. You could actually, if you pass the CPA exam in one state, you could be licensed in all 50 if you wanted to. The problem with that is that you'd have to fill out forms for to keep your license in all 50 states, and you'd have to pay whatever they charge for their licensing. You know, in Illinois, I think it's still $90 a year or something like that. I just went through it last year. Went through it last year. You get licensed for 3 years at a time. I think 2024. I think I'm licensed with 2027. But anyway, so you probably won't want to do that. But what you could do is, let's say that you move from Illinois to Mississippi, you can actually apply and get your CPA license in Mississippi. And you could give up your license in Illinois if you wanted to. You wouldn't have to keep it. And if you come back to Illinois, you can always transfer it back to Illinois and do that. So it's much easier nowadays to do that. But part of the reason why you can do that is that every state uses the AICPA's CPA exam. So while it's just this club, it's a club of CPAs. That's all it is. But because the states use their exam for licensing, they're actually pretty powerful in that respect for determining who becomes a CPA. Okay. Issuers. So, how are these people influenced? Issuers, a lot of times state laws will come from the AICPA. So a lot of times state laws will, especially for auditing. And if you're an issuer in that state, you will have to follow those state laws. If you're an issuer, you'll also have to follow the federal laws. Okay, and this is for auditing and accounting. This is a mess. Hold on. So this is for issuers. State laws, federal laws, and for accounting and for auditing. Non-issuers, they basically have to follow state laws. And many of those state laws will come from the AICPA standards. And so the way that comes about is, the AICPA makes accounting standards. The federal government says that if you're a publicly traded company, if you're an issuer, you must use this club's accounting standards. Now, notice it's just a club. But for accounting standards, you must use this club's. So when the AICPA makes a rule, it's a big deal. And it's a big deal not because the AICPA, but because the federal government, that Securities and Exchange Commission, basically says you have to use their rules. So that's for accounting. For auditing, if you're doing an audit of a publicly traded company, of an issuer, you must follow the auditing rules for the federal and the state. If there's a conflict, you use the federal rules. But the federal rules are some of them are a little bit stricter than the state. But anyway, you have to follow both, and just because you're following the federal rules doesn't mean you don't have to follow the state rules. If there are state rules and they don't conflict with the federal, you have to use it. Non-issuers. If you are a non-issuer, the federal government has no jurisdiction over you, but you still have to follow the state laws, the laws of the state that you're in. Again, auditing standards down here, auditing standards board. These are sort of like the FASB. This is they just make the auditing standards for the U.S. And it's by public. We just talked about that. So every state uses. And it's a good thing, really, because then you can go from one state to the other. Okay, state boards of accountancy. These are the people that actually license CPAs. When did I mess this thing up? Not sure what I did. Okay, state board of accountancy. So state boards of accountancies, every state will have a state board of accountancy. That will license CPAs. So the state gives you the license, and it's just like a car license. That's board. So every state will have a board of accountancy that will license CPAs. All right, so let's talk about that for just a moment. So the state issues a license. Can the AICPA take it away? Suppose you get licensed in Illinois. Nope. Only the state can take a license, just like your driver's license. Can the Boy Scouts take your driver's license? Oh, no, they can't. So it's the same idea that the state's licenses the CPAs, they're the only ones that can take those licenses away. So the state issues them, just like a driver's license. State's the only one that can take them away. And if you think about the CPA exam, it is similar to a driving exam for driving the car. They give you a written test, right? You have to go through the written test. Once you get the written test done and you pass that, then they take you out on the road and see if you can actually drive. And that's kind of the same thing they do for CPAs. You pass the CPA exam, that's the written part. And then you have to work for, it depends on, I think, what you're actually doing. It used to be 1 to 2 years. You need to be professionally employed, basically, to get your license. So again, it's written, and then kind of the road test is when you get that experience of a year or two under your belt, depending on where you're. I think if you're working for a CPA firm, I think it's 1 year. Otherwise, it's 2. I'll have to look at that. So they may have changed that, but anyway, so that's the It's just like a driver's test. It's just like a driver's license. No club can take your license away. Your driver's license. The state can. They can say, okay, you're driving too crazy. We got to take your license away. But it's only done by the state. The state licenses CPAs. The state is the only one that can take it away. The federal government cannot take away your license. The federal government doesn't like what you're doing. They can do other mean things to you, but they can't take your license away. Only the state can take your license away. Okay. Oop. And this is what it should look like. Here's the Exchange Commission. Government agency. So Securities and Exchange Commission. The SEC is the most powerful group. Let me write that. Securities and Exchange Commission. Most powerful government agency. Or publicly traded companies. All right, so if you're an issuer, the SEC says something, you have to do it. If you're a non-issuer, so you're Microsoft. Government says you got to do this, you got to do it. If you're Joe's hot dog stand, you don't. Non-issuers, non-issuers do not need to follow any CPA rules. I'm going to add something to that. For accounting or auditing. Now the state might, if you're working in a state, the state might have rules for businesses and what they can do and what they can't do. But the federal government has absolutely no power over non-issuers for accounting or auditing. So do non-issuers, do they have to follow GAAP? Nope. If you are running your own business, you could make up your own rules if you want. I mean, when you file your taxes and things like that, you have to follow the tax rules. But as far as keeping your books and doing your financial statements, you are not required to follow the generally accepted accounting principles by the AICPA. Microsoft, the SEC requires them to follow. If you're Joe's hot dog stand, you don't need to follow. So, and you will have some, people that are non-issuers who will go use a cash basis of accounting, for example. They do everything in cash anyways, so they use a cash basis of accounting, which is not GAAP. It is a comprehensive basis of accounting, but it's not GAAP, and they don't have to do GAAP because they're not required to. They can keep their records however they want to keep their records. Again, publicly traded companies are under the SEC, and the SEC says you got to follow their rules for auditing, you got to follow the rules for accounting. So that's why publicly traded companies have to. And it goes by the the federal government is really only there for transactions that happen across borders, basically. And so if you're selling it to the public sector, it can, you can be in California and buy Microsoft. You can be in Pennsylvania and buy Microsoft. It crosses the borders. So publicly traded companies are under the Securities and Exchange Commission. Non-publicly traded companies, they can't buy the stock, or they pick and choose who buys their stock. Those companies are not under the Securities and Exchange Commission because it's not considered interstate dealings. Okay. Public Accounting Oversight Board. This is a subset of the SEC. Issuers must follow. Non-issuers do not need to. I don't know why I'm capitalizing these. The Public Company Accounting Oversight Board, also known as the PCAOB, this rolls right off your tongue. So the PCAOB, they are a subset of the SEC. So the SEC, and then this is underneath the SEC. This was created by the Sarbanes-Oxley Act. And just say the PCAOB. Created by the Sarbanes-Oxley Act, and it's there to oversee a company, all their reporting, the reporting of financial statements. And again, the terminology the AICPA uses are issuers. So they won't say publicly traded, they'll say issuers. No, this became, I don't think it needs to be hyphenated. Oh, I guess I had it hyphenated on the lower place. Wacky guy made that. Okay. Now, by the way, we're going to go to about 8 o'clock, and this can be pretty much every time we meet. I know it's technically it's 8:30, but hang in there for a bunch of auditing definitions. If you do it for a couple hours, that's probably enough to last you a week. Okay. Number 7, which of the following organizations can license a CPA?
The state.
Yep. And which can revoke a CPA license?
The state.
Yep. They issue it, they can revoke it. It's just like a driver's license. And nope, the Securities Exchange Commission can't. Most powerful governmental organization for business, but they can't do anything. Okay, getting into CPA firms. Okay, so CPA firms, they come in all different sizes, and generally the size of the CPA firm matches the size of the client. So local firms, they will usually have maybe, say, 1 to 5 partners. It could be just one person. And they will do a bunch of different work. They'll do accounting work. They will do tax work a lot. And they will also do some consulting, probably not a tremendous amount of it, but so they'll actually do the accounting for it, and you can do that. And especially if you have, remember, if you have a company that is not publicly traded, that you can do the accounting for them. And if you're not auditing them, you can do that. They will do audits, but probably very few. Just because their clients oftentimes won't need them. You know, they might need one if they get a little bit bigger and they're getting a large bank loan or something like that. But a lot of times, smaller companies and smaller businesses, if their bank doesn't require them to get audited, they won't get them. They're expensive. Audits are expensive, and a lot of times they won't do it. Oftentimes, banks will, instead of requiring audited financial statements, they'll say, "Send us your tax return." So your tax return will be what they'll use. These are usually in one state. So if it's in Illinois, it'd be Illinois, whatever. And again, you can have one person do it. When you pass the CPA exam, you can hold your shingle out and be a CPA. Regional firms. Those will probably have somewhere between 5 and say 20 partners. And these will usually be in several states. Usually in a region. For instance, in Illinois, it's very common to have CPA firms that work in Wisconsin, Illinois, and Indiana. Those tend to be big groupings. But several states for the regional firms, and they have a little bit bigger clientele. They will get bigger businesses. Whereas the local firms would be more of your things like hairstyle shops and things like that they would have as clients. You get to regional firms that start having people have multiple locations, and they'll be larger companies. And while you'll still do, some accounting, you do taxes. All these places do taxes, by the way, all the firms. You probably do more consulting, and you probably start having audits, regular audits, because a lot of times the banks will they get big enough that they start having loans of, instead of having loans of 100,000-ish, they get into the millions, and once you get into the millions, the banks will say you got to get audits, and so a lot of times the banks will require them to get audits. Usually their clients are not publicly traded. They can be, but usually not. So these are usually going to be for non-issuers. National firms, they could have large non-issuers and issuers. I'll color coordinate those. And issuers will be, and issuers will be pink, if we can see it. Okay. So national firm. These probably have 20 to, could be in the hundreds, but let's say 20 to say 200 partners, depending on how big they are. And they will be in most states. Some of the CPA firms like Grant Thornton is one, is a big one in a lot of states. They will do probably very little accounting. They'll do taxes. They'll do more consulting. And they'll definitely do audits. And, again, generally you're going to have national firms. If you have national firms, they're going to be with these national CPA firms. So national businesses will have national CPA firms, and these could very well be issuers. chain restaurants and things like that. If you're one restaurant, you're probably here. If you had 8 restaurants, maybe you're here. And if you have 180 of them, you're probably here. So as the businesses increase in size, they generally go with the larger CPA firms. Okay, now the big 4 international firms. These are for international companies, and these can have thousands. Of partners, and the partners and affiliates and all kinds of things all over. They'll have issuers, non-issuers. Probably more focused on the issuers though. Oh, I put those, I reversed them. That was silly of me. Well, they're not really, because a good chunk of their clients are going to be issuers. And these are for international companies. And they will be in basically all states and many countries. And for some of the large businesses, these are the only 4 they can basically go to, because these are the only, these are the 4 that are going to be in, all these countries around the world. You look at, like a company like Ford, they have plants all over the world. And you need to have auditors in those. When you do the audit, you need to have people that can go in those countries, and you're going to have to know the language and everything else, and they're going to be the ones that are going to be doing the audit work in those countries that you need to get done. So a lot of times, really, your larger international companies, you're going to need to have a big 4 firm. Okay, any questions? Okay. Which the following types of CPA would be appropriate for an audit firm to perform an audit of a bakery that has operations in Illinois and Indiana?
Regional.
Yeah, probably regional. Possible if they only have 1 or 2, that could be a local firm, but probably not a national. And by the way, just so you know, the audit fees and just fees in generally go up as you go, here they might be $100 an hour, and as you go up, you get into the thousands of dollars. Okay. Now, this actually goes into chapter 3 some, which is probably it's one of the more difficult chapters, but we group auditors in a CPA firm. The AICPA says that they are 4 different groups. They have staff auditors, senior auditors, managers, and partners, and the rules apply to different groups. Now, you may say, well, wait a minute, can't we organize our CPA firm however we want? Yes, you can. However, the AICPA says you must, of all your positions, you have to separate them out into these 4 categories, whichever ones you think they fit most closely. So every single position at the professional level is going to be put into one of these 4 categories, because the rules apply to these categories. There'll be things that staff assistants can do that managers can't, and vice versa. So according to the AICPA, these are the 4 categories, and however you have your company, your accounting firm set up, they have to fall into, you have to somehow divvy them up into these four categories. Okay, so staff assistance, 0 to 2 years. These are when you're first starting out, and you basically will follow the seniors' rules, whatever the senior tells you to do. And I'm going to come back to this in a second. Senior auditors will actually be running the audits. Okay. Now, I want you to see something here. Notice how quick the learning curve is here. So staff assistants, they follow what the seniors tell them to do, basically. And, they're from 0 to 2 years. And if they're doing well, that they'll get moved up to the senior level and run the individual audits. Now, notice that if they're running the entire audit, they have to have varied duties when they're under the staff assistant. You cannot be a specialist in one area because they're going to be running the whole thing. So if you're a staff assistant, you're going to be looking at revenues. And they'll probably switch you around and have you do, inventory, cash, and you get the idea. You need to have these skills. You need to be able to run the entire audit by the time you get into your second year. Notice how quick that is. It's you're in college for 4 years, but in 2 years you have to go from basically being brand new and not knowing how to do the audit. And by the way, auditing is all learned on the job, basically. And by the time that you're a senior, you'll be running it, and you must be able to do all aspects of it. So it's a pretty sharp learning curve. So you're a senior auditor, and you'll be senior auditor for 2 to 5 years. By the way, the CPA exam is directed at the senior auditors. So the CPA exam is directed at the senior auditor. It's the senior auditor's point of view. If you're a staff assistant, you do not need the CPA exam. You'll probably be studying for it. But when you start out, you do not need to have the CPA license when you're a staff assistant. When you're a senior, you must have a CPA. So, it's not needed when you first start out, but pretty quickly, somewhere in that first 2 years, you got to pass the CPA exam if you're going to be a senior. You must have, and you must be able to do these. Basically every part of the audit you have to be able to do. You have to have your CPA license. And the CPA exam is directed at you. It says, okay, you're the new CPA that's actually using your CPA license. You are the one that we're worried about. And me up to these people, we're not worried about. But the seniors with 2 to 5 years experience, these are what they aim the CPA exam at. These are going to be the people that are seen most by the clients. So these are going to be the daily interactions with the clients. Any questions on that? Okay. The last two, managers and partners. Managers will oversee, usually say 3 to 10 audits, depends on how big the companies are. So they will have, they could have 5 or 6 seniors working underneath them. And they'll oversee, 3 or 10 of those, and they'll make sure those audits are, if there's a problem, if there's a problem, there's where it's going to be taken care of. The managers are going to do it. So 5 to 15 years, and they'll oversee, say, 3 to 10 audits. Could be more, could be, if they're big audits, fewer. If they're smaller ones, you have more. Partners, their only job is to obtain clients. You could be a terrible auditor and be a great partner. Your job is to get clients. If you don't have clients, the CPA firm doesn't last. Okay. Just on the next page, I might have to talk about something here. Okay, I'm gonna go over some. I'm gonna go off handout. At CPA firms, it's either up or out. Actually, for all partnerships, it's up or out. And what I mean by that is, if you're a staff assistant, and if they can't make you into a senior, you're going to be out. Notice this isn't 0 to 20 years. This is 0 to 2 years. And again, if they can't make you into a senior, you're going to be out. Same thing with the senior. Oops, too far. Same thing with a senior. Get the 5 years. If they can't make you into a manager, you're going to be out. And management, same way. You get to 15 years or so, and they can't make you into a partner, you're going to be out. So it's up or out. And you might say, well, why is that? Why? What a stupid way to run the business. Well, it looks like this. So here's the partner, partner level, and you have managers. And the managers, you have your senior art. And underneath the seniors, you're going to have, the staff assistants, associates. Staff assistants, sometimes they're called associates. I'll say A's, associates or assistants. All right, so this is kind of, how we're looking at this. Oops, can't see. So we have a partner. You have to have partners to get clients. These are absolutely crucial. Notice that up the stream, something like 1 in 100 people become partners that go into a CPA firm. And you have to have people who can go up, move up to, at some point, become partners. They have to, there has to be partners. You have to have partners. So let's say you have an associate down here and they're really good. They do their job very well, but you just can't make them into a senior. Maybe they specialize in something and they just can't get the other stuff. Maybe they're good at inventory, but they can't do cash or whatever, So if you were to leave those people on, that would cut off that, they're never going to be up here. And if you let this person stay again, and at some point, the firm will go bankrupt. So it's an up or out life at the CPA firm. All right, so, and it doesn't get any easier as you go up, by the way. It's still, you even reach partner. You reach partner, you're going to be spending a lot of time on golf courses and stuff. You're going to have all kinds of expenses you never thought you'd have to have, but you have to join golf clubs and other things. But anyway, as you go up, there has to be these open spots because 1 in 100 is going to come up here, and if you start choking off these, these 100 that come in, and get down to 50, 10, whatever, at some point you're not going to have any seniors, you're not going to have any managers, you're not going to have any partners. So it is, partners don't live forever. So it's crucial that it's either up or out. Now, you say, well, how terrible. What a terrible place to work. Okay, and in some ways it kind of is, but being out is not necessarily bad. Being out of a CPA firm is usually a good thing. All right, and here's why. Oftentimes they'll get you jobs with their clients. So if they have Microsoft as a client, and they have you, and they say, okay, we have this associate, we just can't, we don't have a spot, for them as a senior. Can you guys? Oftentimes they'll go to the client will say, yeah, sure, send them over. CPA firms have a reputation of being the top accounting people and the top finance people. So oftentimes the clients will really like having them come. And by the way, usually they get a bump in salary and they get much better hours. If you're working in like public accounting, 70, 80-hour weeks in the busy season are not unusual at all. Go to Microsoft and they probably start treating you a lot much better. And so it's usually a good thing. And the CPA experience is highly sought after. And it can literally, catapult you, say, 5 to 10 years into the up the ladder. If you have 2 years CPA experience is it really makes your resume pop. So moving up the ladder is even if, you know, you know, where is it? What do I do with it here? You know, even though you have, you know, 0 to 2 years experience, that 0 to 2 years experience is going to move you up very quickly. And maybe you'll start out as a, you know, an accounting manager someplace that would normally take you 10 years to get to, you might have just done it in 2. So having that CPA exam or CPA firm experience is very important. And that's why, one of the reasons why it's so popular for people to go into, if they want to get into it, is because, great. One of the reasons why they want to get into it is that they can look like Dracula. No, they want to go into it is because, you know, hey, you know, you may not last in there, and like I say, you know, you go work for a company, it's going to be, I'll guarantee you, it'll be easier work. You can actually have a life. So even though, you know, upper out might seem very cold and, you know, not much of a future, at the same time, it's very sought after. So it's very sought after because you might get into a client, and usually that, you know, those are pretty good jobs. And even if you don't go to the client, you know, just having that on your resume is huge. And there's some jobs that they'll only list. They'll say must have, you know, 2+ years of CPA firm experience, and those are usually very well paying jobs because it's a very prestigious thing to do to work for the CPA firm. So my point being is that when you plan on going into accounting, obviously, it's not a bad idea to think about maybe going to the CPA firms. CPA firms, they're a little bit tougher to get into. However, you know, the benefits are much better, you know, as you move up. And if you pass CPA exam and get the CPA firm experience, I mean, it's really as valuable to do that. It'll really move you up a number of years in your job if you can get those 2 things. Now, this is something that is a little bit quirky about CPA firms, and that is I would definitely get with the people who are lining up internships and see if they can get you into CPA firms. And there are CPA firms around that will take you in. Generally speaking, CPA firms like to have people do internships, and then they give them offers after the internship. So a lot of times in your junior, sometimes in the senior year, you'll do your internship, and from that internship, you'll get the job offer. So, you know, putting it off to the end sometimes isn't the best thing. It's not saying that you won't get in one. You may very well get in one, but generally the offers come about a year after the internship. You know, so if you're going to be graduating in 2027, you know, and you should probably get an internship in 2026 because that offer they'll give you an offer for that. And a large amount is somewhere in the 90%, depending on what firm you're looking at, 90, you know, even high 90s, that interns will be hired by the CPA. You know, and they'll bring into your culture and, you know, all that kind of stuff that they have. There's another quirk to this though, and the quirk is generally interns from one CPA firm are not going to be hired by a different one. So it isn't like you take an internship at this CPA firm you don't want to work at because you really want to work at this other one. That really doesn't work. They want you to do an internship with them, and they'll hire you from that. If you go with a different CPA firm and do your internship, they're going to have a question as to why you're not working for that firm. So it's important to, you know, do your homework, and if you are going to go into work for a CPA firm, you know, you can search the internet, you can do a lot of stuff to find, you know, what people think about different ones and what the big ones are, what the big regional ones are, and that sort of thing. But do your homework when you're a junior, because it makes a difference as to where you're gonna work. And usually, like I say, like 90-some% of the time, the intern will get a job offer to work in that firm that they take through the internship with. So that's kind of a quirk. You know, you can't mix and match the internship with the job that you're looking for. They generally go hand in hand. Any questions? Okay, let's call it a night, actually. What we have left? I don't think we have too much left here. And then next week we'll also have the I'll do the CPA questions and send out the exam, and we should get started on the sample. So next week we'll finish up with chapter 1 and 2, get started on some sampling, and we'll do the CPA exam questions. And that will be the first time that we'll turn in anything. So the handout and all that. I'm going to move the handout back. It's going to be turned in the 12th. But we didn't finish it. Any questions? No one say anything. All right, well, that'll be it. And this video should be posted hopefully by tonight. It's still recording, isn't it? Yes, it is. Yay. All right, and I will see you guys in a week. Question?
Yeah,
Thank you.
I have one question for you.
Yeah.
So, I was recently last summer. I had an internship at a firm. It's Zurich, like right by the Schaumburg campus.
Right.
My aunt works there, and I haven't like really like gotten an offer or anything. Like I would like say I did a good job, and I collaborated well, and I learned a lot, but I haven't like received any offer yet, like a full-time offer. So would you say like should I like apply to other firms or like look for something more local?
Was it an internship in is that
It was for
a,
it was for last tax season.
okay, but you're doing mostly taxes?
Yeah, basically.
Okay. Well, you can also look for firms that might take you on as for an auditing intern.
Okay, yeah, that's what I've been looking at. Like I saw PwC does audit. Like I was also looking for something just like more like around my area.
Yeah, and by the way, doing taxes, there's nothing wrong with that at all. That's a very good area to be in, actually. But yeah, so if you want to, you know, and that's what I would tell them, that you know you're interested in doing the auditing. If you are interested in doing the auditing is you know it's a different, you know, generally they have the three areas they hire in are usually taxes, auditing, and consulting. And the taxes will have their own internships. Auditing will have their own internships. These are different partners. They'll have their own internships. And so will consulting. Consulting is oftentimes not the accounting. They can be, but oftentimes they're not. They're kind of like MBAs and stuff like that. But but certainly the taxes and the auditing in the CPA firms, those are the two areas that you can do internships in. And if you want to do with a CPA firm, you know, do the internship, that is, you know, that's also a good area to go into. I don't want to, I'm teaching an auditing class, so I'm telling you all about auditing, but the CPA firms also have positions for people going into taxes, and that's huge too.
Right, yeah, because I feel like the plan that I've been like trying to have is with me and my friend, we want to kind of like make our own firm after like
Yeah,
a couple years experience. So I feel like for that it's kind of needed to have a CPA. So we're trying to be partners. So
yeah, absolutely. And another cool thing about, well, a good cool thing about taxes, especially, and to some extent auditing too, when you get into your CPA, but for taxes, the cool thing is you can actually set that up that you do that as a side business and have that take over, because you know it's good to have a regular paycheck come in sometimes before you hang the shingle out. And I worked with a guy that actually did that. He worked for a company. We actually worked for ComEd, and he had this tax business on the side, and finally the tax business just took over. And he's probably billing out these hundreds of thousands a year. But yeah, one of the cool things about accounting is that you can actually do it on the side and establish your business. You know, instead of just jumping off the cliff, you can actually establish it by doing work. And yeah, growing the firm is definitely something you can do. And again, CPA firms, they're small CPA firms. I don't want to dismiss those at all. People making very good money, the smaller CPA firms, and doing what they want to do. I mean, they pick their own clients, they pick their own whatever they plan on doing. They accept tax work and consulting and all the other stuff as they please, which is not always the case when you go into the bigger firms. Any other questions? But yeah, I would say if you want to go into auditing, I would definitely try for an auditing internship. And you can say that's what you're interested in, auditing is auditing. But also, if you have tax experience, getting a tax internship with the firm you want to be with, it was not a bad idea.
Thank you so much for that. Like, I feel like this class I've learned so much than in most of my accounting classes.
Well, good. Yeah, and the whole idea, question?
Oh, I was just going to ask, do you have any recommendations for someone with a full-time job looking to transition to audit? So I currently work as a accounts payable supervisor, and I'm interested in internal audit, but I do agree and I understand that most companies prioritize those with public accounting experience.
Actually, internal auditing is, that's actually what I did. I worked for U.S. Steel and I worked for Navistar. Navistar makes trucks, but
Mhm.
I worked for those two companies. I think U.S. Steel, I think this is sold or something. Yeah, I think they were sold. But anyway, so yeah, I actually did internal auditing. Internal auditing is, I don't know if it's still this way. I used to do tons of traveling, and that was the only thing that was, well, it was the good and bad. The good of it was that a lot of those jobs were open. They became open more. I don't know if they do that much travel as they used to, but yeah, you can definitely get into internal auditing. And this is just from my experience. Internal auditing for me was actually it was much more interesting because there was much more varied. Working for a CPA firm, if you're doing audits, it's all financial. It's for the most part financial accounting. When I was doing I did audits of human resources. I did audits of there's design departments and all kinds of stuff. It was very interesting. It was something that you would not do if you're doing a CPA firm. The CPAs would come in for 5 weeks or whatever. We would take 8 weeks just to do one department and learn so much about it. My understanding of how companies work went from like zero. My first job was internal audit. Went from 0 to 100 miles an hour. So the first, when I worked for Navistar, the first couple of weeks I was there, I was actually in a meeting with the president.
Wow.
That doesn't happen, to a large, no one else in a large company. I mean, that happened to, but internal audit, you're looking all over the company looking at, you're talking with, department heads, plant managers, you're talking with all these people that are very happy you would never interact with otherwise. But yeah, it was a internal audit I really liked. I really liked it.
So as an internal auditor, would you recommend the CPA or the CIA?
Either one of those would be good. The CPA is more universally known. It's not. It's a very narrow license actually. It's only for doing financial audits. That's it. And most people that are CPAs don't do financial. I don't do financial. I'm a CPA, but I don't do financial audits.
Okay.
But the CIA, I actually have a CIA. The first place I worked at, everybody else there was a CIA. So it's like okay, when in Rome, I better. Yeah, so I sat for the CIA exam after I became an internal auditor. And by the way, the CIA exam when I took it, it was a very difficult exam. I felt like it was more difficult than the CPA exam to some extent. But the CIA exam, it's directed at people who are actually doing audit, complete audits, and they'll ask you to write an audit program and stuff that they don't do on the CPA exam. However, but I'd also say the CIA at least when I was going through, you had to work in internal audit or else you wouldn't get the CIA designation.
Okay.
And the reason I say that is you may pass that difficult exam, and then if you don't work in internal audit, I think I had to work in it for 2 years. If you don't work in internal audit, you don't get that designation. But no, the CIA, the Certified Internal Auditor, and the CMA, the Certified Managerial Accountant, those are not licenses, just so you know. Those are
Okay.
by different organizations, but they're very highly looked upon, and I look upon both of those as the equal to the CPA, even though they're not licenses. But again, the CPA is a license, but it's a very narrow license, you know. So yeah, yeah. I love the work. I love the certified internal auditor work. Again, back when I was doing it, I'm talking about like 30 years ago. Yeah, like 30 years ago. We used to travel all the time. I was on the road for 10, 11 months a year. And when I got married, that was when, even though I liked the work, it was
It's challenging to be away from
Yeah.
home so often.
If you
Yeah,
want
I
to
get
stay
it.
married, you gotta
Okay. Well, thank you very much.
yeah, I would definitely look into it. I love the work of internal audit. It was so varied and so, if you like learning, it's definitely is probably one of the better fields to go into in accounting.
Oh, thank you. Have a good evening.
No. Okay, well, we can talk more about this stuff. Yeah, so I'll see you guys next week.